Interest rates, they're going up in the US Treasury bond market. That means the economy is on the rebound. Things are looking more optimistic. Reflation, recovery? Maybe. My name is Emil Kalinowski, and I'm going to talk to Jeff Snyder, the head of global research of Alhambra Partners. Jeff, I almost called you George Gammon because we're going to be talking about George Gammon again. We talked about him in part one of this episode, and I can't get enough. I want more, George. More.
I don't blame you because George is a very engaging guy, right? I mean,
Yes.
he's really interested in learning about this stuff. I thought it was terrific of him to say exactly you were just setting this episode up as is, hey, bond yields at the long end have risen. Hooray! That means inflation, right? The market has changed its mind. And then we discussed all the ways that that's probably not the case. But that's really, that's where we begin is that we have this, most people have no idea about the yield curve and interest rates at all. In fact, we talk about all the time, the interest rate fallacy, they've got everything upside down. So it's not surprising that most people have trouble trying to interpret the bond market, the yield curve, something that's really so basic to fundamental finance, which just goes to show you how terrible a job the profession and discipline of economics has done generating any kind of real useful financial literacy.
And the university system. I'm not going to let them go by unscathed.
The university, it starts from where you start in college or the university, and it goes all the way up through your everyday adult life where the financial media simply parrots what central bankers tell them, even though they can't make sense, hide or tail of what's actually going on in the system. The yield curve in particular is always a source of confusion and conundrum, when in reality, it's actually very simple. But it's not as simple as interest rates down equals bad, interest rates up equals good. There's more to the story, and that's really where we are today.
You made a funny comment in this article that the officials know enough about bond markets that they want to change the subject. The article itself that I'm referencing is called Good Time to Go Fishering Around the Yield Curve, posted at Alhambra Partners on the January of the 20th of the 2022. Okay, Jeff, you said there are three variables that we need to keep in mind when we're looking at the yield curve. Variable number one, the relative nominal level. Variable number two, the relative direction of the change in yields. And number three, the curve's shape. Let's talk about number one very quickly, which is the relative nominal yield. Higher is better and lower is worse.
Yeah, possibly.
Good.
Again, it's there's a little bit of complexity and nuance to it, right? But just taking a view from a 30,000 foot level, looking down on the yield curve, we see the yield curve with maxes out around the 30-year at a little bit over 2%. That's ugly. That's awful. That's not good. Doesn't matter how it's changing in the immediate term. Longer run, you see a curve that low and flat, that's indicative of only economic and financial problems, downside cases, and too much deflation probability. So relatively speaking, if the yield curve is changing, even if it's changing more favorable in those other two criteria, if it still doesn't really change out of its low shape, there's already a red flag there. We're already saying that, okay, yeah, maybe it's improving, but is this really an actual meaningful improvement?
You're spoiling the whole show, Jeff, because yes, that's the bottom line. But if we were just to isolate,
okay, there are other bottom lines.
If we were just to isolate this one variable, is that generally a good rule of thumb for an advanced economy if we see interest rates higher in the future than lower? That's my predisposition. And I think that's what George's was. And now we're going to add in variable 2 and 3. But do I have that right? Because I don't want the audience going around there saying this to strange people on the street saying nominal interest rates are up. That's a good thing. I want to make sure we're all right.
That's where we're starting. Nominal interest rates going up could be a good thing if all these other criteria are met. And one of those criteria, the first one is, are interest rates rising to a relatively normal range? You think about it this way. If the yield curve looks more like the curve in Japan than it does the United States in the 1990s, things are not going right. Things are not changing meaningfully for the better. And by the way, spoiler alert, the yield curve in the US, even today, after this massive sell-off that you've heard about in the media, which is just a tiny blip of a market fluctuation in any kind of real context, we are nowhere near the 1990s yield curve in the United States or any healthy curve anywhere around the world at any point in history that you would associate with healthy economic and financial circumstances. We are still much, much closer to the Japan scenario than not. So right away, we start out with criteria number one. We're in the low Japan-like state. And so the question becomes, we're in the Japan-like state. Are we transitioning out of it? And that's where these other two criteria come in. Are they telling us we're leaving Japan and going back toward normal, or in the minds of many around the world who are screaming at the top of their lungs about this bond route, are we leaving Japan not for normal and healthy, but for the 1970s inflation? And that's where these other two parts of the curve come in.
Gosh, Jeff, I'm surprised because I've been told that Japan is experiencing lost decades. Some have even called it a depression. And yet recently from the White House, the American White House, I have been told that the last year was the greatest growth in jobs and economic activity possibly on record in human history. So that those two things don't coincide, but maybe I misunderstood. Let's move on to variable number 2 then. The relative direction of any change in yields. And here you say we need Fisherian decomposition. Short-term rates, long-term rates. What are they pricing in?
Well, Irving Fisher over a century ago, and I think we've repeated this mantra quite a bit over recent months.
When the Federal Reserve,
for good reason.
Yeah, well, the Fed's not watching the show, Jeff. Maybe they didn't watch one of the previous episodes, so let us repeat it until they watch the show.
Irving Fisher, early 20th century, said long-term bond yields are a combination of growth and inflation expectations. They're that simple. So growth and inflation expectations, which means we can kind of decompose them into parts. Now, mainstream economics likes to add a third part, which is called term premiums, which we're not going to bother with because that's an entirely made up thing to allow economists to fit bond yields somehow into their econometric models. And we don't need to go into the details behind that. If you're interested, I left a link in the article where I discuss why term premiums are utter crap. And they're simply a made up Orwellian type term to allow economists to claim low interest rates are something that they're not. So we have this decomposition where bond yields are a combination of growth and inflation expectations, which also means they have to incorporate the yields in front of them. So if you're a 10-year treasury, you've got growth and inflation expectations, as well as what are the nominal short-term yields in a given time period. So it's really a combination of growth and inflation expectations on the one part, and then the future projected path of short-term rates on the other. Put those two things together, you've got the long-term bond yield.
You say growth and inflation expectations, just to make sure I've got it in my head correctly. Growth is economic activity. And then we say inflation. We don't mean consumer price increases. Do we, Jeff? We mean monetary expansion. Is that what bonds are pricing in? Monetary expansion.
Yeah, again, we're talking about, again, in terms of the interest rate fallacy, the idea that demand for safe and liquid instruments, which U.S. Treasuries certainly qualify for reasons of liquidity more than credit worthiness. Anyway, safety, liquidity characteristics, when they're in high demand, you're not going to see nominal opportunities in the real economy very strong. Therefore, as you just said, Emil, we're talking about monetary inflation, nominal growth in the economy, what it actually looks like outside of consumer prices that might be, as now, being moved by factors that have nothing to do with the monetary system.
Now, Jeff, all of that discussion, I believe, belongs to the medium to long-term outlook. In my mind, 5 to 10 years or so. But did you discuss it? Maybe I missed it. What about the short end? You say here in this article, it's the expected path of short-term rates, which we would turn to our favorite central bankers because they seem to be moving around the short-term interest rate. So is that correct?
Yes, the short end is influenced by the fact that the Federal Reserve, even though it's not a central bank, does offer investment alternatives. And these days, that means something like IOER or the reverse repo, which helps the Fed define its federal funds target rate. So if you were holding a 2-year treasury, for example, and it's yielding, say, 50 basis points in yield, and you think the Fed is going to do 4 rate hikes over those 2 years, suddenly you could get a 1% rate at some point in the future on nothing more than the IOER or RRP. Are you going to hold a 2-year treasury even if you think it's priced relatively well at 50 basis points? No, the 2-year treasury is going to adjust for these alternative investment considerations the Fed is going to use in setting its monetary policy. So the short end of the yield curve, in many ways, especially when we get into these changes in rate hikes or rate cut cycles, the short end of the yield curve is highly influenced by what the Fed is expected to do, not just what it's done in the recent past, but what is expected to do based on obviously signals the Fed is sending, speeches, proclamations, forecasts, published forecast, anything. So if we expect the Fed to raise its these investment alternative programs that it offers, it's going to affect especially the short end of the yield curve. And in what we see historically, as we talked about before in these conundrums, that is the only factor that affects the short-term end of the yield curve.
Okay, for variable one, we gave an example. Variable one was the relative level of nominal yields, 1990s versus the post-2008 experience. Now let's give an example for variable two, the relative change in direction of nominal yields. And here in this article, you say from the lows of August 2020 to the highs of March 2021. What did we experience? What did it mean for variable two?
Emil, that was the good one, right? Mm-hmm. That was, okay, we don't meet criteria number one because the curve is low and flat. In fact, in August of 2020, it was as low and flat as it has ever been. In fact, it was so low and flat, it wasn't even a curve. But it was changing. It was changing, right? Nominal rates were rising. So we saw, okay, that's a good sign. And we saw that most of that rise in nominal rates wasn't because of the expected future path of short-term interest rates. It was because of growth and inflation expectations. So the yield curve steepened. That's the magical happiness pathway to normalcy that we want to see. We want to see, even though criteria number one is bad, criteria number two, the curve is essentially steepening out. Interest rates are rising for the right reasons that are not the Fed. They're for growth and inflation perception. Now, where we combine those two criteria together is that process topped out March of last year, almost a year ago. It topped out at an incredibly low level. So it was better than 2020, but only marginally better than 2020. So in 2021, what the curve was saying was, we're not changing from a Japan scenario to a normal scenario. It just means that we're no longer at the extreme low end of the Japan scenario, and that the future may be not as bad as 2020 had been, which was an incredibly low standard to judge against. But that's really what the curve was saying.
That's nothing to celebrate. It's like saying, well, I feel better now that I'm not getting a roundhouse to the left kidney. Great. That's no improvement. I mean, exactly. Well, it's an improvement, but all right, I'm still sore. It's a relative improvement.
And that's why we use these multiple categories of criteria. It's a relative improvement, but it was not a categorical change.
Now, a beautiful work of art, ladies and gentlemen, a graph that just captures everything here. We're going to pull that up. And Jeff, we're going to move on to variable number 3 and use this graph so that we can provide people with an example. And again, variable number 3 is perhaps the key one, the most important one, maybe.
I think so. I think you agree with me, right?
Yeah, that's
we talk about a curve shape.
Mm-hmm.
Okay, nominal yields seem easy enough, but it's to me, the more important variable is always curve shape, steep or flat. Now, let's preface this section by saying that the yield curve should not be steep. It should always be relatively flat, but as long as it's in that normal range of criteria number 1, right. A flat curve at a normal nominal level is actually a good sign. But we aren't there. We're in the Japan scenario.
Right. So let me just interrupt. Once we've recovered, we should see a flat curve.
Yes.
But during recovery, to get there is when we see the steep yield curve.
Yes, and if it's missing, was the curve, right? I mean, that was the curve last year. Okay. The early 2021 curve, nominal rates were rising. Our third criteria, the yield curve, was steepening. So even though we were still in the Japan scenario, it looked like in early 2021, there was at least a small plausible probability that maybe things were normal. We were moving in the right direction. The bond market was becoming a bit more optimistic. The problem is that it topped out at a low rate. And ever since March 2021, things have gone in the opposite direction, especially in terms of criteria number 1 and criteria number 3.
Right. Okay. So we're looking at this graph now, Jeff. We have from, let's see, August through February. What month are we in? January 2022. So from August 2020 through January 2022, different tenors of the US Treasury yield curve, the short term and the long term. And then you've done a Fisherian decomposition, short term rates and long term rates. And we now know what they represent. And you've drawn arrows, and we've just discussed part one, the low point, and then where we were in March. And now we've had an intermission, and now we're at a point where, yes, the nominal yield is higher. Good news.
Slightly. I know. Let's talk about that too. I mean, the way you hear about it in the media, you'd think that the interest rates have skyrocketed. As it stands today, the 10-year Treasury yield is exactly the same as what it was in March of 2019. Let me repeat that. The 10-year Treasury today is about 1 basis point off of where it was in March of 2019. So for, what is that, 10 months, it's gone 1 basis point higher. That's not how it's characterized or talked about in the media. And then, of course, what we're really talking about is all these other curve dimensions that you need to take into account that help us explain why that is, what's really going on here.
Okay, so the last bar that it corresponds to where we are today with this yield curve shows we've had a massive increase in the expected path of short-term rates. Federal Reserve, Jay Powell, even in Europe,
Hawks are everywhere. They're flying all around, right? It's when you plot all of these parts of the yield curve on the chart, as I've done here, showing you here, you can absolutely see these parts of the long-term yields, this Fisherian decomposition. The expected path of short-term rates, especially since around October, you see it clearly in the 2-year Treasury yield, they have gone up by a lot. And that makes perfect sense because Jay Powell, every chance he gets, along with all the other Federal Reserve members, along with all the other financial media, are saying rate hikes, rate hikes, rate hikes, rate hikes, rate hikes. And the market is saying, yeah, we agree. You are going to raise rates. We're going to adjust the short end of the yield curve because you are going to raise rates. But that doesn't mean that the Fed is right in why it's raising its rates. And that's where we get into the other part of the yield curve decomposition, which is when you subtract off this large increase in the expected future path of short-term interest rates, what's left over for growth and inflation expectations in the nominal long year, the 10-year or the 30-year long bond has shrunk considerably over the last couple of months. So even though nominal yields are rising in the long end of the yield curve by a little bit, they aren't really rising all that much. Even over the last couple of weeks, even over the last 4 weeks, they're up maybe 40 basis points from their low. That's not a big move. But even though they're higher, the yield curve is flattening. Breaking down yields by Fisher's work, we see that most of it, in fact, the majority of it, has been the expected future path of short-term rates, which means growth and inflation expectations in these yield curve today are falling. They're getting worse. They're not getting better.
So yes, I guess it's a question then of who do you trust? Do we trust the centralized, highly credentialed authorities who say the economy looks brighter and it's a very tight labor market and there's inflation, we see it in consumer prices, therefore we have to raise interest rates? Or do we trust, as you called it, the undefeated bond market with those long-term expectations? Jeff, for people that are looking at this graph, I just wanted to, maybe they'll think the same thing I did, because I wanted to quibble about that first bar, the second bar. You increased the short-term rates a lot relative to where they were in August by March 2021. Is that because you were looking at the 5-year? Is that what you're interpreting as the short term? Because I would think it would be the 2-year, and the 2-year really didn't change that much. I would think this second bar that you drew, that long-term expectations should have been much wider, and short-term were still almost, I would say, unchanged, almost unchanged. Tell me if I am misinterpreting.
Well, you can interpret. I mean, we're not using mathematical precision here. We're sort of saying judgment. Yeah, you're right. I looked at the 5-year as well as the 2-year, and the fact that the 2-year didn't move meant that the expected path of short-term interest rates across the entire curve probably didn't move all that much. Certainly not in their immediate projections. But the fact that the 5-year did move up suggests that the market was thinking, even in late 2020 and early 2021, that interest rates were not going to stay at zero forever. So yes, we went from a period where in August of 2020, everything was low and flat. The expected future path of short-term rates was awful. And so there was some slight improvement. It wasn't much, but it was some. And maybe I have overrepresented it just for the purposes of illustration on the chart. And you're great. I'm so glad you pointed that out for Emil.
Just people,
but, yeah, there
maybe
was. I think
so
there
we can
was
all learn.
no, you're right. I mean, we should. There was some degree of increase in the expected path of short-term interest rates. I mean, you're right. It wasn't much. It wasn't a huge deal, but there was something there. And I wanted people to see that, yeah, I think that was part of the yield curve expansion up until March of 2021.
I think it would even buttress your case more to bring down that short-term bar in the second bar, bring it down, because then it would show how much long-term expectations have been shrinking with your measures from March to October to January. Jeff, okay, well, as long as we're complaining, no, I'm helping.
Hey, remember how we started out this segment of the show? You guys say interest rates fall is bad, so interest rates are rising. It must be good. So in terms of complaints, I think that's the biggest one.
It's not all right, criticism. It's a critique. It's a personal assault on your character, Jeff. No, what I want to say is, which graph is missing here is the one that you did a good number of times, I think last year, is the one that shows the relative increase in yields relative to the previous inflations. And I think that would be variable number 2. That would help people see, yes, it's gone up in a good direction, but compared to the previous reflations, 2009 to 2011, 2012 to 2013, 2016 to 2018. And that would bring home again how even variable 2, even though it was heading in the positive direction from August 2020, compared to what we had seen before, there's not a lot of beef there, as we used to say in the 80s.
That's usually criteria. That's criteria number 1 judged against criteria number 2. Criteria number 2, interest rates are rising, but they aren't even rising as much as they did previously, as you just said. And I think that's an important point that says we're still in the Japan scenario. We're still closer to the Japan scenario than anything not. And you go back 3 years to 2017, 2018, 2019, where rates, the 10-year yield got up to 3.25%, and everybody's, the highest rate in 7 years. This is obviously a regime change in the bond market. When again, if you use criteria 1 and number 3, you would have seen that wasn't really the case. It was good while it was positive, I suppose, that nominal rates were rising. That was mostly the short end too. Is exactly the same process. The Fed was hiking rates, pressuring the short end of the yield curve, which was resisted in its longer term inflation and growth expectations, as well as these low nominal levels that it topped out as, which suggested that no, this was not a meaningful change in the bond market. The only thing that had changed in 2018 was the Fed. And that's really our lesson here today. The only thing that has changed in the bond market between last year's more optimistic take and this year's less optimistic take, even though nominal rates are somewhat rising in both time periods, the only thing that has changed is the Fed.
Fantastic. That's exactly how you ended the article, Jeff. I wanted to read it out, and you did it again. You said the only thing that's changed is the Fed again. Here, let me read the first part of that quote. All we can definitively conclude for now is that there is and has been no change in the bond market perceptions about the balance of future probabilities, that with low nominal levels and an increasingly flat shape, they are tilted decidedly toward the not inflation and unfavorable for whatever the latter might end up. Very good, Jeff. We're going to move on to part 3, which involves supply chains, chicken wings, the Buffalo Bills. What else? China. This is fantastic.